Welcome to the deep dive. Ever stop to think about income or expense? Is it just about, cash coming in or going out?
Or is there maybe a bit more to it?
Exactly, because the timing of when money is earned or paid, well, that can actually have a huge impact on your taxes, your cash flow, everything.
It really can. It's subtle, but powerful. And it's something a lot of people don't fully grasp.
So today we're going to dig into accounting methods, specifically how income gets recognized for tax purposes.
Right. We'll look at how the when of earning or paying can fundamentally change your financial picture. It doesn't matter if it's personal finances, a small business, or even investments.
Our goal here is simple. Cut through the confusing stuff, maybe uncover a few surprising details, and give you a shortcut to understanding these honestly crucial financial ideas. Ready to jump in?
Let's do it.
Okay, so when we talk about tracking money, whether you're, a huge company or just starting out on your own, there are basically two main ways businesses do it.
Two main pathways, yeah.
Yeah.
Cash basis and accrual basis.
Even if you think you know basic accounting, this difference is key. It's where a lot of confusion starts.
Absolutely. Let's start with the simpler one. Cash basis accounting.
Okay.
Think of it like balancing your checkbook. Income gets recorded only when cash actually lands in your hand or your account.
Expense?
Only when you physically pay them out.
Yeah.
It's very straightforward, very intuitive, like how most of us handle our personal money.
That sounds, well, easy. What are the upsides for maybe a new small business?
That simplicity is the main advantage. Your record keeping is easier, costs less, and you always know exactly how much actual cash you have right now. Gives you a very clear, immediate snapshot of cash on hand.
But I sense a but coming. That simplicity must have a downside.
It definitely can. Because it's so simple, it can sometimes give a skewed picture of your company's real financial health.
How so?
Well, it doesn't show money that's owed to you, like unpaid invoices, or money you owe, like upcoming bills. It's just cash in, cash out.
I see. So it misses future obligations or receivables.
Precisely. And the IRS puts limits on it too. If your business, say, averages over $26 million in gross receipts over 3 years.
Which is quite a bit.
Right. Or if you carry inventory that you sell, you generally can't use the cash basis method.
So the IRS basically pushes you towards the other method once you reach a certain size or complexity.
Exactly. Those thresholds are triggers, cross them, and you're likely looking at accrual basis accounting.
Okay, let's unpack this accrual method then. What makes it different?
With accrual, we're looking beyond just when cash changes hands. Income is recorded when you earn it. So when you finish a job or send out that invoice.
Even if you haven't paid yet.
Correct. And expenses are recorded when you incur them, regardless of when you actually pay the bill.
So it's more about the economic event itself, not just the cash movement.
That's a great way to put it. It gives a much more complete and, frankly, more accurate view of your financial situation over time.
And that's why it helps assess performance better, right? For planning and things like that.
Exactly. Accrual uses something called the matching principle. It tries to match expenses with the revenues they help generate in the same time period.
Okay, makes sense.
This gives a truer picture of profit and loss. It's why bigger companies, generally those over $25 million in average revenue, or any company with inventory or credit sales, are often required to use it. It's really the standard for serious financial analysis.
But it sounds more complicated, more work.
It is. Definitely more detailed records. You need a better grasp of accounting rules. And here's the kicker.
Uh-oh.
You might end up paying taxes on income you've earned on paper, like an invoice you sent out, but haven't actually received the cash for yet.
Ouch. That could pinch your cash flow if you're not careful.
It absolutely can. It's a trade-off.
Yeah.
Accuracy versus complexity and potential cash flow timing issues.
So many businesses might start with cash basis because it's easier.
Right, especially when they're small.
And then they grow, things get more complex, and they kind of have to switch to accrual.
That's a very common path. But switching isn't automatic. You usually need IRS permission. There's a form for that, Form 3115. It's a formal request.
Good to know. So that covers how income is recorded, cash versus accrual. But now, here's where it gets really interesting, especially for taxes. It's about when income is legally considered yours, taxable, even if the cash isn't physically in your pocket yet.
Ah, yes. You're talking about constructive receipt.
Exactly.
Yeah.
What is that, in simple terms?
Well, think of it like this. The IRS basically says, if you could have gotten the money without any major hurdles, then as far as we're concerned, you did get it.
So even if I didn't pick up my paycheck?
Right. Income is considered received and taxable when it's credited to your account or made available to you without any substantial restrictions. It doesn't matter if you've actually taken possession of it.
So the main reason for this rule is to stop people from, say, delaying picking up a December paycheck until January just to push the tax into the next year.
Precisely. It prevents artificial deferral of income. The key isn't whether you have the money, but whether you have the unrestricted right and ability to get it.
If there are real obstacles, like the money isn't actually available yet, then it wouldn't apply.
Correct. If there are substantial limitations or restrictions, then it's generally not considered constructively received.
Can you give a classic example? This feels important for year-end planning.
Sure. The paycheck example is perfect. You get a paycheck dated December 30th. You could go cash it or deposit it, even if you wait until January 2nd.
It counts for December's taxes.
Yes, because you had control over it in December. And this doctrine, it primarily impacts taxpayers using the cash basis method we talked about earlier.
Okay. And what about things like crypto? Does constructive receipt apply there too?
Oh, absolutely. If you gain control over cryptocurrency, maybe through mining rewards, staking, airdrops, or getting paid in crypto, that's generally taxable income.
When?
At the time you gain control, based on its fair market value at that moment, even if you haven't converted it to dollars yet.
So just leaving it on an exchange doesn't help if it's already credited to your account and you could withdraw it.
Nope. If it's available to you without substantial restriction, the IRS considers it constructively received, taxable event.
Wow. So constructive receipt brings clarity and stops some tax games.
Right. It provides clear rules, consistency.
But the downside is you could face a tax bill before you actually have the cash readily available. Limits your planning flexibility a bit.
That's the trade-off. It can lead to unexpected tax hits and complicates things, especially with newer forms of income like crypto.
Okay, so the when can be tricky, and sometimes the rules feel rigid, but you mentioned sometimes the IRS actually gives you flexibility on timing.
Yes, there are specific areas where you do get choices, and a prime example is U.S. savings bonds.
Savings bonds. Let's talk about those. How does timing work there?
Well, first off, the interest you earn on Series E and Series I savings bonds is subject to federal income tax. But here's a nice perk. It's generally exempt from state and local income taxes.
That's a decent benefit right there, especially in high-tax states.
It really is. But the really unique thing is the timing flexibility for federal taxes.
Yeah.
You typically get to choose when you report that interest income.
Choose how?
Instead of reporting the interest each year as it accrues, which is how most bond interest works, most savings bond owners choose to defer it.
Meaning
You wait and report all the accumulated interest at once, either when you cash the bond or give it away, or when it reaches its final maturity. For E bonds, that's 30 years.
30 years of tax deferral. That sounds powerful.
It can be a very powerful tool, yes. Tax deferral is a major advantage.
But why would someone not defer? Why choose to report it annually?
Good question. You might do that if you expect to be in a lower tax bracket now than you will be later.
Like maybe for bonds held for a child.
Exactly. Parents sometimes report interest annually on bonds in a child's name, though they need to be aware of the kiddie tax rules. Those rules can sometimes tax a child's investment income at the parent's higher rate.
Okay. So it's about optimizing based on current versus expected future tax rates.
Precisely. And what if you change your mind about how you report it?
Can you switch?
Yes, but the rules differ. If you've been deferring and want to start reporting annually, you generally can do that without asking the IRS first. But the change applies to all savings bonds you own under that Social Security number. And you have to report all the previously untaxed interest from all those bonds in the year you make the switch.
Okay, so a potential big tax hit in that 1 year, what about going the other way? From annual reporting back to deferring?
That's harder. Switching back to deferral usually does require IRS permission. You'd typically file that same form we mentioned, Form 3115, or follow specific steps in IRS Publication 550.
Got it. And isn't there also a potential tax break if you use savings bond money for education?
Yes, a very valuable one. You might be able to exclude the savings bond interest from your federal income tax if you pay for qualified higher education expenses in the same year you cash the bonds.
That sounds great. Any catches?
There are income limits. For 2025, this exclusion starts to phase out if your modified adjusted gross income, or MGI, is above $149,250 for joint filers or $99,500 for others.
And it disappears completely at higher incomes.
Right. It's fully phased out above $179,250 for joint filers and $114,500 for others in 2025. So it's targeted to help moderate income families.
Makes sense. What if you give a bond to someone else? Who pays the tax?
If ownership changes, like reissuing an electronic bond, the old owner is generally responsible for the tax on the interest earned up to the date of the change.
And the new owner.
The new owner is responsible only for the interest earned after they took ownership. It keeps the tax burden tied to who actually benefited during which period. Paper bonds can be a bit trickier, as the final 1099 might show all interest, requiring proof of prior reporting.
This all kind of ties back to the idea of a tax year, doesn't it? When does the clock start and stop for tracking all this?
Absolutely. For most individuals, the tax year is simply the calendar year, January 1st through December 31st. That's the default.
But businesses sometimes use something different.
They can. Businesses might use a fiscal year. That's still a 12-month period, but it ends on the last day of any month except December.
Why would they do that?
It lets them align their tax year with their natural business cycle. Maybe their inventory is lowest in June, or business is slowest then. It can make accounting and tax prep smoother.
And you choose this tax year, calendar or fiscal, right at the beginning.
Generally, yes. A taxpayer chooses their accounting period, their tax year, when they file their very first income tax return. It's a foundational choice that affects how all these timing rules play out.
So what does this all mean? We've covered quite a bit today.
We really have.
We looked at the big difference between cash and accrual accounting, how just changing when you record things changes the whole financial story.
Then we got into constructive receipt, the interesting rule about when income is considered yours for tax purposes, even though you haven't physically received it yet.
A key concept for cash-basis taxpayers especially.
Definitely. And then we explored U.S. savings bonds, which offer that rare flexibility to defer interest income, a potentially powerful planning tool.
Right, with some important choices and limitations, like the education exclusion rules.
Understanding these concepts, accounting methods, constructive receipt, deferral options, it's just fundamental for managing finance as well. Doesn't matter if it's personal or business.
It really highlights that finance isn't just about the dollar amounts, but also about the rules surrounding when those dollars count.
Exactly. It has a whole other dimension.
So we hope this gives you something to think about. How do these timing rules affect your income, your expenses, your investments?
Yeah, think about the choices you might have. Even small decisions about timing can paint a very different picture of financial health. And, of course, your tax situation down the line.
It really encourages being proactive, doesn't it? Thinking ahead about these things.
It certainly does.
Yeah.
Planning makes all the difference.
All the best. And we will meet again with another important tax matter in the next deep dive.